and Larry has graciously offered to um, kind of do a question and answers today. So what I'm going to ask is that everyone mute themselves, and then if you have a question, just say in the chat box, "I've got a question," and then you can unmute yourself, and then that way we'll just see how it goes. You know, we're all still, it's been a year, but we're all still kind of learning how Zoom works. So yeah, if you have a question, just let me know, and then you can unmute yourself, and I'll kind of like call on you, and you can unmute yourself. But there's no dumb questions, there's no bad questions. Feel free to ask anything real estate related, tax real estate related, or accounting real estate related. This is really just an open source opportunity here. So Larry, anything you want to add before we start with some questions?
No, I said you guys just kind of go after it. I mean, a little about myself. I've been doing this for about 3 years. I graduated from West Point. I played football there for 4 years. Got out kind of a serial entrepreneur. And as you guys know, anytime you start something up, if it goes, you have to keep good books. You have to do all the taxes at the end of the year. So I did a lot of research. I used to do them all myself, and then I kept researching, and then slowly but surely my friends would start kind of pinging me for this question, that question. And then one of my friends who is a real estate agent just pinged me and said, "How much does it cost for you to do this?" And, you know, I've been kind of up and running. So, just send the questions.
Awesome. All right, guys, we'll just start putting in the chat box if you want to go first. While we're waiting for them, I'll start with an obvious one that comes up all the time. But for people who are newer to the business of as a real estate agent, what are some, I mean, I know you could probably spend hours talking about this alone, but what are some easy deductions that every real estate agent should be taking that maybe aren't the obvious? Like everybody knows they should be taking, you know, a portion of their gas, you know, by tracking their miles and things like that. But, you know, a lot of people don't know about the home office tax deduction, things like that. Maybe not everything that you can deduct as a real estate agent, that would take forever. What are some of your favorites that maybe people don't know about?
So, I mean, the easiest way to sum it up is anything that you do, touch, or go through to sell your homes needs to be deducted. So it's like tough to like, what are like pinging and different strategies like that, like what to do? Like it's literally everything you touch. So like your home office to when you get to your car, when you drive, when you network. I think the best thing for real estate agents is your guys' travel, because everything you guys do is generally trying to sell to a customer or a networking opportunity. So really building out proper itineraries so that your travel is tax deductible, right? And especially as you kind of grow into entities and you take trips with people on your team, there's ways that you can structure that so it's tax deductible. So a lot of people that we have, you know, they're real estate agents, they have the LLC, the entity. When they take their end of the year, their year-end trip, well, we structure the shareholders meetings and different kind of networking events around it so that that trip is a tax deductible event and not the entertainment. But again, if I can help you get back portions of your food that you're going to eat, the entire trip that you're going to take, so the fare and like, you know, the rental car that you may or may not rent, I mean, that's a big deduction, right? You're looking at, you know, anywhere from $400 to $1,000 just at the end of the year. And you start getting the self-employment taxes, things of that nature, like you're looking at $300, $400 deduction. So for real estate agents is networking opportunities, really be deliberate in how you're capturing those, because those are great expenses for you guys.
So just to clarify, and Larry, correct me if I'm wrong, what I'm hearing is, so many of you probably know you can, when you file your taxes, you can file it as an individual, or you can form a corporation and file your taxes that way. So are you saying that only if you are receiving your commission as a corporation, is that the only time that you can deduct a whole in the year trip, or can you do it as an individual?
So so the year-end trip is very specific to the entity, right? But if you travel and you end up networking, so the easiest one for me, I have a tax conference every single year down in Dallas, Florida, somewhere nice. You know, we're supposed to get out, we never do. But that trip, even if I wasn't an entity, is a tax deductible event because I'm going to go down there to work, right? And work is networking, learning, education, or just you trying to expand your opportunities. So if you take a trip and you go to, like, if you go to Florida for any kind of real estate conference, well, that's an education event. That's not just you traveling, right? So even though you're going to work 4 hours a day, which is kind of the number, stomp, the 4 hours is really what you want to pay attention to. If you're only working 4 hours a day and you work from 8 to 12, and then from 12 to 8, you're just kind of going out, like that's still, that travel there is still a tax deductible event. And this is why I'm very explicit, because there's different kind of things to, like, you know, wrap the weekend, travel days, holdover days, things like that, that we can kind of capture to create a plan, right? And that's where we transition from, hey, like, here's my tax at the end of the year to, hey, how should I go forward to save some money, right? So that's kind of being proactive rather than reactive to your tax situation. And that's open to you as a sole proprietor all the way up to an S corporation.
Awesome. Christy, you asked a few questions, so I'm just, if you want to unmute yourself, Christy, and go ahead and ask your question. And then Robin, I see you're next after that.
Hi, Larry. Yeah, so my first question is, I'm pretty new to this, so I've only gathered like really receipts for like gas purposes and like my sign that I've purchased. So is there like an overall cap on like real estate expenses, like for my own personal business, like say anything that exceeds 12,000 in a year, I don't need receipts for all that stuff because literally I could only claim like a certain amount on taxes.
No.
Okay.
So you're kind of in, I don't know if you're having the right conversation. So no, if you spend it on your business, it's a tax deductible event, right? Again, okay. I have clients that they'll make 100K and they'll write off 80K, and that's just what went into the business. Where you may have heard that, or where that kind of comes up in conversation, is if you start to have negative income for 3 out of the 5 years, the IRS could do what's called a hobby loss. I think it's a hobby loss retraction or a hobby loss audit. And essentially what they say is like, hey, you're not making any money in this. That's a hobby and not a business. A little bit different for real estate agents because, again, you guys are active, you guys are working, you guys are putting back. It's very easy to show that it's a business, but that rule is created for the person who kind of starts that home business, losing $8,000 a year. But again, there is no cap. Even if you draw a loss for a couple of years, that loss will offset kind of future years or offset your active income in that year, but there's no cap. So get that out of the brain.
Yeah. So just to elaborate a little bit on that, Christy, essentially any expense that you have, and we'll talk more about some other expenses, and we won't get to all the expenses. That would be impossible to cover in this meeting. But you and I can have a conversation about that. Any expense that is a legitimate expense that you have in your business, whether it's your MLS fee to miles that you're driving for showings, to even and again, I'm not the tax professional, so I'm going to defer to Larry on some of these things. But even like buying clothes, some clothes that are especially branded clothes, that's marketing, right? Yep. Anything like that is deductible, even if you say make $20,000 next year and your expenses are 25, you can still take a loss. Yep. So it's all deductible. He's just saying if you have multiple years of that, like for example, I'm going to have that happen because I sometimes DJ weddings and I charge for it, but it's really a great excuse to buy speakers and other cool things that I love. And so I take losses every year on that. And I'm pretty sure pretty soon the IRS is going to be like, that's a hobby. And it totally is. But that's the only real exception with a cap. It's not really a cap. It's just like you might get called out if you have year after year after year of that. Is that correct, Larry?
And that's how it is, right? And again, your tax professional is going to help you structure it that way, right? So if your question is what kind of things can be expenses, that is just, again, that's kind of the most wide conversation. Like the easiest one is like the Grant Cardone 10X conference. That's a tax expense for so many people because they're going down there for an educated conference. There is no cap. Again, we're managing those losses over multiple years, right? But again, you'll even see it. It's just you see people like the failed business adventure, like that's probably a negative loss there. And then that negative loss offsets other income. So same with Isaac, he loses in the DJ income, but it's offsetting his real estate income. So that's how the interaction works.
Next question, Christy.
And that kind of answers the like the desk fee too, because if the Northwest MLS, the Super E-Key, all that stuff is included in that, then I get that too.
100%. And then again, that's pretty it. I just want to touch on your second question. You said, is it home to the location or from the location to the location? I was confused.
Yeah. So like, let's just say if you're going to show like 6 homes to somebody, you have it all mapped out for like the day. So you're going from home to the first home, my house to the first house.
Okay. Yep.
Let's just say if we take a break in between, like, I have like 30 minutes to an hour by myself. I'm not even with the client, but I'm like, I'm going to go grab myself lunch or go do this thing. Like, am I able to track mileage? I'm tracking mileage from my home and then to all the homes that I'm showing the person. and then not in between when I'm just kind of doing my own thing, but picking up from, I'm getting lunch at, let's just say Mickey D's in Tacoma, but going on to show my next 3 homes. Is that right?
So you brought up a perfect thing, and I'm glad we touched on this. So you're leaving from your home to a location to show is a tax deductible mileage expense. Okay. Leaving from your home to the office is going to be seen as a commute. So be cognizant of that. So if you ever come to the office, check in for a meeting or something, and then you go show home, the mileage from your office to the showing is going to be tax deductible. As far as like the space in between, as I like to call dead space in the schedule, it's just kind of the easiest way to see it, where you're kind of filling it with lunch or administrative things. Those are generally tax deductible. I caution you that, pigs get fed and hogs get slaughtered, right? So if you're showing from, at 1 and then your next is at 8, to count all that dead space between that 2 p.m. to 7:45, like that's where you'll get hemmed up on that stuff. But if you're like, hey, I got a showing an hour, I'm going to run something to eat, like you're still on the clock.
Okay. Thank you for that.
Quick tip on gas mileage.
Oh yeah, we got it.
They're not expensive. The apps are so cheap, and just get an app. There's all these apps where you can just be like, okay, I'm going to show homes, go, and it tracks every mile. And when you're done, I'm done. And then that way you can be as honest as possible, and just only market when it's actually you're actually doing traveling for work. But for investors, I tell investors all the time, if you're going from your rental property to Home Depot back to the rental property, you're just tapping it on, tapping it off. So the apps are so worth it. They're not expensive.
Is there one that you suggest?
So it's really shooter's choice. So I'm aggressive to get my clients to have books. Right. So just accounting books, and we'll kind of go on that later. So I like the QuickBooks mileage app. I believe it's called Traverse, or I can't remember, but it's really honestly what I would do is I would download 5 and figure out which one it is, because it's all interface and they all work pretty solid. They're all going to give you the same thing. They're all usually going to kind of talk to your accounting system that you'll eventually get. It's really just how do you like the interface. So I would download 5, use it for a week, but Isaac's absolutely right. Like your records are everything in the IRS. Because when you give me the stuff to do your taxes, or you give your tax professional, you're generally turning in your income statement and all the peripheral things that need to be kind of depreciated that went into the business. You're not going to give them every receipt. And a lot of the time, I don't request a mileage tracker, right? Like I'm going to say, do you have it? And you'll sign in the engagement letter that all your documentation is honest, but I'm not going to request it. So a lot of it's for you, because if the IRS comes and audit you, like a lot of this stuff is producing the record to show that this happened. And so a lot of what I do in the planning phase, as opposed to the preparation, is I teach you how to document, right? So like, if I ask you guys where are your receipts right now, how would you guys respond? And then
in
usually,
my wallet.
See, and that's an aggressive way to do it as you expand, right? So like, there's different kind of filing systems. We can get in there later. I won't bore you. I would work to get it on an e-filing system, right? And it's as simple as taking a picture, right? So what I do, because I'm crazy, I have a account called Larry Receipts at something.com, right? It's random letters because I never want anybody to accidentally send me anything. And every time I purchase something, I take a picture on my phone and I send it directly to that email. And in the actual message, I say, hey, I spent, what did I just buy? A tax book for $48.99, or I just bought this legal session with yada, yada. And I literally just submit it in there. So if anyone comes out at me, we're going to have a great time, because not only is it searchable now, but I can pull it off at any device and it's ready to go.
So
I love that.
2 quick things. Number one, so as to best use this time to take advantage of your knowledge. Robin actually texted me and I was thinking it right at the same time. What I'm going to do is either next week or the week after that, I'm going to do a kind of basics class on just best practices for tracking tracking expenses. And I'll mention a bunch of apps I use. I love apps. I'm the king of having apps. Make my life easier, and in reality most of them probably make it almost harder because I'm in and out of them. But anyways, I'll share all that. I have some great apps for filing receipts and all that. I'm just thinking, great questions, Chrissy. I'm not at all, those are great questions. I'm just thinking to best utilize Larry's time, because Larry can answer tons of questions I can't answer. Let's table the rest, just this conversation, and we'll do that in a week or so. But I think that'll be a really good meeting. But just to really quick, just reiterate something that Larry said that's so important. I didn't realize this when I first became self-employed. When you're filing your taxes, you don't need your receipts. You don't need explanations for everything. That's only if you're audited. So like you should have all that. I'm not saying, don't have that. I'm just saying if you hire Larry or anybody else to do your taxes, or you're doing your taxes on your own, it's essentially all you need is profit and loss statement, right?
Yes.
What did you take? What were your expenses? That's it. And then filing the taxes properly, because you get different deductions for different items, right? That's important, but that's really it. You're going to say, this is what I spent on mileage. This is what I spent on hard expenses, i.e. Northwest MLS, your $100 tech fee here with our office, right? $100. Those are hard expenses. And then you've got things that you get partial deductions for, like meals and entertainment with clients, et cetera. We don't need to spend too much more time on that, but just that's really important to remember. You're not going to be providing everything to your accountant. That's only if you're audited, which, knock on wood, hopefully never happens.
Nope, and 100%. So he's right. Just to answer the last question, your desk fee is tax deductible. And then going into Robin's question, the biggest benefit of the LLC, right? So upfront, I'm not a lawyer yet. I'm in the process of becoming a lawyer. So in the next 2 years, I'm going to become a lawyer, right? So let's start there. This technically is not legal advice. The LLC is what's called a disregarded entity. So the LLC itself does not change your tax situation, right? But that's very important. So that's not going to take it to a new level. Its biggest benefit tax-wise is that when you make money, so if I have a client make between $40,000 and $50,000 a year, I recommend them strongly set up the LLC, because as we go through that next year, you're generally going to go up. And once you get to that kind of $40,000 to $60,000 range, the biggest benefit is you can go from an LLC and do what's called an S Corp election. And that S Corp election is kind of when you take that next step in running a business. And the easiest way to say this is that the S Corp differs from the LLC and a sole proprietorship in the bifurcation of income. And what that means is you take your income in two different ways. So as an S Corp, you pay yourself a reasonable wage. Again, we can call reasonable compensation among all tax people there's conferences on it. So you'll pay yourself a reasonable wage, and that will come in the form of a W-2. And that second form of the income comes as a distribution. And where this kind of makes its money is that distribution bypasses that self-employment tax. So you're saving that 15.3% self-employment tax. So really, every $10,000 you move through that distribution stream is going to save you about $1,530 in real taxes. So that's the biggest benefit, right? And then there's more advanced strategies we can layer on, but I don't encourage people to do that up front without a professional, right? So the second strategy that you'll see is called the Augusta loophole. And this is the one that you may have seen. I don't know, for some reason, my niece showed me on TikTok, it's blowing up, but this is renting your home to your business, right? So I can't recite the exact tax code or the publication, but essentially there's a clause that says if you rent your home for 14 or less days, that's a tax-free event, right? You don't claim taxes on that rental income of 14 or less days. So what we do is we rent the home out to the business, right? And that business pays you a fee, and then you can kind of put about, depending on where you live and comps and things of that nature, about $500 to $1,000 per rental. So I have people take that easy $12,000 deduction. And again, that's saving you your marginal rate plus self-employment tax. So again, that's another key thing of having the LLC. But again, proper planning prevents audits. So, and then Jane had a question.
Sorry, Jane, you are totally next. I just want to say something along these lines. First off, there's a point where it makes sense, and I'm not a tax professional, so I'm not going to say what it is. You should talk to your tax professional, whether you hire Larry after this or anybody else. But there's a point where it makes sense to take your commissions as an S Corp. But it's a point when you're making a certain amount of money, because it costs money to do that. And it's also more expensive to file your taxes because it takes more time for someone like Larry. So if you're doing 4 deals a year and you're making, you're making gross 40,000 a year, you're probably not there. It's probably not financially beneficial at that point. Again, I'm not a tax professional. I'm not saying that number is the magic number. I'm just saying if you are considering doing the S Corp or the LLC, at that point, I really would encourage you to definitely hire a tax professional to help you.
Yes.
And then talk to them about these strategies, because it's not as simple as, oh, I'm going to save money and I'm only doing 2 deals a year. There is a magic number or at least a magic range that you want to talk to a tax professional about.
100%. And like I wouldn't have the conversation unless you're netting like net profit. So after expenses, after everything, you're netting kind of that 50 to 60 range. That's when the conversation starts. And again, there's a lot of situations to take in, but if you're not making that net, that 50 to 60 range, it's not going to be worth it. Cause like you said, the administrative costs, payrolls, reporting, it's going to get so costly that you're not going to get the bang for your buck. So as a general rule of thought, that net 50 to 60 is a good place to start talking to people. And it may be there and it may be a little bit more, but it really depends.
Love it. Okay, Jane, go ahead.
Okay, hi. Really quickly, going back to write-offs, et cetera.
Yeah.
I keep like a itemized document, I guess, of every expense that I have. If I buy a closing gift at Home Goods or whatever, the date I purchased it, what it was for.
Yeah.
But I don't keep a receipt. If I were to get audited, is that okay? And I can pull up my bank statement, or am I going to be kind of screwed?
Okay. This, again, another big argument. So this is an awesome question. To start off, start at this moment saving your receipts, because this is what's going to happen, right? If you bought something from the gas station, right? Because you see it all the time. We all buy gas. Well, if you just buy gas, it's just going to say Chevron. But if you go in there and buy beers, it's just going to say Chevron on your statement. So if you get an auditor who's having a bad day and he's like, no, that could be beer. And you're like, that makes no sense. Like, why would I buy $48 of beer? And he's like, no, that's beer. And he throws that purchase out. You have no records to then combat that. So the receipt is the ultimate. Some people, I hate to say it, but it kind of depends on the auditor you get. Will look at your bank statement, like, that's fair. And some is easy, right? Like when you say, like when it says turnkey realty, like fee, like that's going to be super easy. When it says like tax book conference, like everyone's gonna be, oh, that's too, but it's those quandary zones and really those supermarkets, Target, Walmart, things like that, where it's going to get hasty, right? Because again, if you buy, the worst I've seen with one of my clients, he bought a desk from Walmart, cost $580, and that was thrown out because, again, right, and we had no defense. So the receipts are the mecca. You can get by, but you won't last. I promise. As you grow up, it's just not going to be worth it. Receipts. And again, I'm just going to have some good strategies for you guys, but start saving your receipts.
I'll make myself an email address.
The way to think about it is if you are, just think like an auditor, right? An auditor, like Larry already alluded to, when they see that you're getting a consistent $100 a month bill from Realty One Group, they're not going to ask for receipts on that. Like we have it, we give you that in your year-end statement, but they don't that's not what they're looking for. But they are looking for, like, I have an Airbnb, and so I deduct thousands of dollars of expenses, real expenses from Costco. I'm absolutely keeping those receipts because first time I get audited, it hasn't happened. They're gonna be like, all right, let's see these Costcos, right? And I'm gonna have to show them, no, see, I have a receipt here, and that's where my, steak and things like that is, and my groceries. And I have this one, and it shows toilet paper, paper towels, sheets, etc. But I have that to show that. So even the gas example, like, if you get a auditor in a bad mood, he might call that out. That's even one where, like, I will sometimes write off gas and be like, oh, I forgot to get a receipt. I'm not worried about it. I doubt they're going to be calling me out on that. But think like an auditor. Think like someone who is going into this already suspicious, right? And think what are more likely things. Gifts is a great example. Like, you got your gift at the Apple store or Walmart or Costco, like, okay, definitely keep a receipt there, because they're not going to give you the benefit of doubt.
No.
Okay, one last question on that.
Oh,
sorry.
Oh, I'm sorry. Jane.
And then Robin, you can go after that.
Yeah.
Okay, so for gas, Isaac, you said sometimes you write off your gas. I always track my mileage, and I thought you couldn't do both, right?
Yes. You cannot do both.
Okay.
You cannot do both.
Thank you.
There's strategies, but please don't do this off your own. Choose one if you're doing your tax for yourself, which is super cool. Not telling you have to, but don't do both. You cannot.
Okay. Thank you.
No problem.
Sorry, I said that very confusing. As an example, in my opinion, my unprofessional opinion, it's so much easier to track miles than it is to track receipts and then try and figure out miles is so easy, especially with the modern technology. Robin, go ahead. And I know you had a question next.
So I'm always afraid the tax man is going to get me. So what I do is whenever I have a receipt, like if I'm taking out a new broker that I'm interviewing to join us, I'll just write coffee with Jane at the top and then take it home. And then at the end of the week, I spend like 5 minutes pulling out all the receipts in my wallet and scanning them to my email. And then I keep them in a folder that I have by month.
Yes.
And it correlates with my Excel sheet that sounds the same as Jane has.
100%.
That's a great lead into a great question. And I'm sorry if I'm skipping somebody who asked a question, but because you said that, Robin, this is something that I actually am curious about. Noting on your receipts. So we've talked about best practice is that keep your receipts for everything. Even better practice, my understanding, is to write notes what it is, right? Because if you buy a TV from Walmart and you don't write a note that it was a gift for Christy, who I helped buy a home, that'd be a pretty sweet gift. But then, so I guess I'll just shut up because I think my question is clear. Larry, what is your opinion on notes? Do you always take notes, or do you sometimes take notes? And if it's sometimes, when are those sometimes?
So if I'm ever, and again, I'm the furthest extent, right? There's overkill. So I'm prudent, right? That's my job. So if I ever have an interaction with another person, it's properly documented, right? And not properly documented, let me rephrase that. It's overly documented. So who, what, when, where, why. Like I generally have the 5 W's on all my receipts, right? And again, that's overkill. But as you start interacting with other people, because again, the question's going to come up like, what were you doing at the dinner? Because how do you differentiate a business meeting between a non-business meeting, right? It's tough if you're sitting there. So again, I like to over document. The 5 W's will always cover you, but at the very least, like what were you doing there with who?
So for example, I took Andrew Meyer to dinner and I paid for it. And then I'm going to write at the top. You don't have to write a story, right? No. It doesn't have to have proper punctuation. I would just write Andrew Meyer, buyer, talking about buying a home, paid for dinner.
100%.
Right?
100%. Okay. And then you're moving through. Again, like you don't have to the auditors, the easiest way to say this is the IRS is not going to spend time trying to throw out something that's documented, because like if they lose and that's where it is, and like you can imagine like in the grand scheme of things for taxes, like that $40, that $80, that $300 meal is not worth it. So again, that documentation, I'm overkill, but again, like it's not a story, it's not a long thing, it's who you're there with, what were you doing, right? Or why were you there? Either way you want to look at that. So
love it. Craig asked, or I'm not skipping you, Robin, right? You got your question out. Did you get your question answered, Robin?
Yeah. Well, I guess I had another question. So for like Christy and I, we both got our license last year, but we haven't had any income, but we have been spending, obviously, business cards, signage, etc. So we can take that as negative income on our taxes this year, since we didn't make any money in our real estate business last year.
I recommend, just because of the 3 for 5 rule, I would just treat it as a startup cost. So you will get those. And then if it's less than $5,000 at the year you make income, then that $5,000 is deducted. If it's more than $5,000, it's going to be depreciated, capitalized, they're kind of the same word, but a little bit different, over those next 10 years. So
Just take the L.
Yeah, I would take the L, do the startup cost. Again, I'm prudent, right? So you might see someone that's more aggressive, but my job is to save you from yourself and look out for that 8-year gap, right? Like tell my clients, like I'm here to play your defense for you. And then I'm out here to look for 8 years, and I'm an aggressive defensive player. So I'm always looking for wins for you, but I'm never going to let somebody score. And that would let the IRS kind of into your books, kind of looking at you. And just because this year, I don't want to tie politics into it, but politically, like they gave more money to the IRS, the number of auditors have increased, and the Schedule C is the most audited form, which the Schedule C is that sole proprietor profit and loss statement, right? That you're claiming on your deduction. And so that's just the most scrutinized form. So I'm always protecting. So I would just hold on to it. As soon as you make that first income, we look at how those startup costs are going to be deducted.
Love it.
Awesome. Thank you.
Craig's question is, please clarify the deduction for client meals and client entertainment. Are they both 50% deductible? I believe meals went from 100% 2 years ago to 50% today, and entertainment went from 100% to 0% question mark.
Okay, so this is a little story. I'll say it quickly. Tax Cuts and Jobs Act under President Donald Trump, or ex-pass, in 2017 changed the deductions for meals to 50%. And entertainment went down to 0. So you can no longer do it. We can talk the case law later if you want to. It's kind of interesting. After the CARES Act that was recently passed here, you probably heard about the 3 martini dinner. So in order to kind of stimulate, like provide an incentive to go out to eat, your meals until 2022 are 100% deductible. So now they were 50% deductible, but now in 2021 and 2022, those meals are 100% deductible. So understand that for the next few years and kind of, you know, it's going to benefit you guys because, again, you guys do so many client meetings. You guys probably go out a lot. You guys are often away from your home. So, you know, if you're meeting with the client, eating with the teammate, that's a tax deductible event.
And I want to be really careful when I say things like this because, again, excuse me for being so redundant with my disclosures. I'm not a tax professional and I'm not telling you how to do your taxes here. But like Christy, I saw yesterday you went out to dinner with Holly, and Holly literally said, you know, talking real estate. That's totally legit. Like yes. Larry has already said he's conservative, but don't think. It's good to be conservative and to not push the boundaries. But if you are at dinner with another agent or whatever, or like my wife and I, at least once a month, we write off a dinner that we have together because we're talking about our rental portfolio. Yes, that's not, and that's legitimate. That's not, I'm saying, I know on recording on YouTube, that is 100% legit. That's not fishy. That's totally allowed. So there's a fine line between being sneaky and trying to get away with things and just doing things that are absolutely legitimate. So remember that it's not, there's nothing shady about going to dinner with Holly, who's also a friend of yours, Christy. You guys were talking real estate. That is an absolute legitimate business expense.
Yep. And again, like I am prudent, but like it's my job to be prudent and your job to be aggressive, right? And so that's why I always recommend having like a tax person kind of in your pocket. Because again, I get text messages literally. I'll get 12. I've had 8 today, like no exaggeration, 8 today. Like, hey, Larry, I want to do X. How does this tax deductible? Is this tax deductible? Like, you know, someone asked me, I want to buy an Audi. Can I use the 179 expense, right? The answer is no. I'm going out to a meal. We're taking a trip. Like, so that's why you kind of do it. Cause like, again, that event when you're going out talking real estate, education, getting better at your job, or you're talking about your own real estate, like that's a business meeting, right? 100 times out of 100. So I want you guys to take the expenses for the things that you're incurring to be better at your job. But again, get with somebody to help you build a fence around it. But yes, that going out to eat, coworkers talking about the business, that is a tax deductible event.
Awesome. Christy, do you want to ask your question yourself?
Sorry, having technical problems here. Okay, so my question is, so again, I'm new, but if I were to pay someone, like if I wasn't able to meet with a client and I'm paying someone to open doors for me, is that a tax deduction?
Yes, 100%. So where you would want to be cognizant, and it's a little bit different, right? Because I'm assuming it's on the same team, right? So it's a little bit different when you're in there on the back end. So if you're paying, for example, just a random realtor, you're generally going to want to do documentation to support that. So a 1099, and we can kind of get to that rule later. But if you're paying someone, if someone's helping you make the sale, if someone's helping you make money in your business, that's a tax deductible event. Like that's pretty much it, right? Like I have realtors that have people go hammer signs for them. That's tax deductible. I have realtors have their kids pass out flyers, tax deductible event, right? So all that stuff's good. And then on the marketing side, same concept. If you are paying to grow your business, it's a tax deductible event. It's probably the biggest. Like looking at Intuit, like the TurboTax, the parent owner, their profit and loss statement, their biggest expense is marketing and advertising. So it's super okay that even as you start to, you know, have more success, if you have that massive marketing budget, it's completely normal. It's completely normal, like billions of dollars. That's why it's $100 billion industry, because everyone's marketing and everyone's advertising.
And I'll flip that on its head. I'll flip that on its head really quick. This is important to note too. If you are showing homes, the IRS is like the casino. The house always wins. So if it's tax deductible for me to pay You
Ooh,
a home, it is taxable income for you, Christy, to claim that. So technically that is income. That is not me giving you $100 because I am writing off that I gave you $100 as an expense because I'm making a $10,000 commission and I want that to come off of my commission because it is a legitimate expense. But you made 100 in income, and so you need to claim that technically in income. So just
100%.
Oh, okay. So I do need to track that for 2021. So I showed that homes got the money. So that's my income that I made. from
Oh,
that.
yes,
Okay.
yes, yes. And that's
On
what
the
the 10,
flip side, I'm just saying, well, both sides is good to know. Yeah.
100%. And so that's why the 1099 becomes important. And again, we can get on that later, but that's why it's important because like you said, they're going to get taxed. So you're not just giving them money, you're passing your tax burden. And if you don't claim it enough, what they're going to come back and say, hey, you've just been giving a bunch of gifts. So if I've been paying somebody $10,000 and it's not properly documented, not paid for, then they'll come to you like, well, hey, this is your tax burden now. And that's why we document. But yes, he's absolutely right.
Yeah.
And
think of it like a business, like Realty One Group. We pay myself, Sarah, Andrew, Robin income, and that's payroll, and that is a deduction of what we make. But Andrew, Robin, Sarah, and I, we all claim that income as income. And so again, just always remember the house wins. The house always wins. Yeah. And so they're going to get their taxes one way or another. And if I'm calling it a deduction, then you're calling it income.
Okay.
And for us, if I can interrupt, the easiest thing to do is if you're doing a lot of showings for somebody because they're out of town and you have 4 different showings and they, one's $50, the other one's 100, the next one's 150. Sorry. And so then the best way is through escrow on your commission that you had 10,000 in commission, but you paid $450 out to another broker on a referral form 11, and now it's clean that your the settlement statement shows your 9,550 to you, and that's done. You could have a separate bill of sale to the partner agent to itemize those items, but on a form 11, Northwest form 11, MLS form 11, you could create that and have it go through escrow. That'd be the cleanest way. Otherwise, you do it after the fact, and I know a lot of you probably will. Then you're just going to have to do a little bit more detailing. But if it comes straight off the top, then the person who referred it out doesn't have to worry about it. They just have their net commission.
The complicated part about that, Craig, is that like I had a bunch of people show homes for me while I had COVID a couple of weeks ago, and I don't want them to have to wait 2-3 months for my buyers to close on a home. So I appreciate that Robin showed homes for me, and so I paid her right away because I don't want to be like, okay, I'll pay you in 2 months when they finally close on a home. So that's kind of the problem with that. I hear what you're saying; it's cleaner, but it kind of gets difficult with that.
Yeah, it can't be done all the time, but it would be cleaner if you do it that way. So it'll just be case by case.
So and I see you have another question, Craig. So I will get to that. So we have our first investor question. When would it be beneficial to form an LLC when working with others on an investment property? Should it be formed before the first deal, or should you still wait until you have net income for a certain amount? I guess the question is, if I'm buying a property with Andrew Meyer together, at what point should we, what's the order of operations there? At what point would you encourage someone to form an LLC right from the get-go, or when you guys are actually filing your taxes?
You kind of look at it, right? So the LLC is not going to affect the tax situation, even in a partnership, right? So now we're getting into the legal aspect. And what I would always say is it really doesn't matter, right? Because the partnership is not binded by the LLC. It's binded by the agreement, right? So if you're not going to do a long-term partnership and you're just doing a joint venture, we do up joint venture agreements, right? And so I work with a law firm and I do all the paralegal work, the scut work. And so we create the joint venture agreements. And this is the agreement that's going to police this partnership. So the joint venture agreement or the partnership agreement should be established before you guys start conducting the business. The LLC, it doesn't matter, right? So a lot of people like to have their LLC first and then move their property in. That's fine. A lot of people like to create it after. Whatever it is, don't let the LLC stop you from acquiring the property. the agreement first. The agreement's going to lay out what's going to happen if we sell, if someone wants out, how do we buy someone out? What if someone passes? What if we get sued? Like, what if we have a dispute? And like, do we it's the agreement's supposed to answer all the questions of the business. So that is the most important part. The LLC can come whenever you're ready to protect the asset. Because again, that's a liability issue, not an establishment of the partnership, and not going to affect your tax situation, right? Because if there's one or if there's two or more people, you're going to end up on the same partnership form, right? So again, the agreement, which is something that I don't know if you guys talked about there before, but let that be the first thing that's discussed, and let that be ironed out, and let that be signed. It doesn't need to be notarized, but everyone should sign that.
Great advice. I love what you said about don't let the deciding on the analysis paralysis on the LLC. Don't let that prevent you from buying a home. That is we should be careful before we give tax advice to our clients. But I've had so many people who want to get into real estate investing, and they're like, yeah, I just don't know if I should have an LLC. And I'm like, oh dear God, like,
yeah, exactly.
We'll talk
100%.
You are on the sideline. It's like worrying about pulling your hamstring and all you do is ride the bench. Okay. Like let's worry about getting on the field first.
100%. And like realistically, like if it was crazy and they're super insane, like LLCs can get set up in like 2 to 5 business days. Right. So like I tell clients, it's just like, we'll buy the property, get your umbrella insurance, and then handle on the other side. But the joint venture agreement, like that is the thing. I've never had to go to court. I've never gone to court with a lawyer. I've never had any of my clients go to court, but you just hear stories. I read case law. Like again, I'm getting ready to go to law school. So like I read so much case study, and that joint venture agreement, that partnership agreement is everything. I have contracts for everything. My mom lent me $100 to go buy her something, and I sent her a PDF contract to sign on DocuSign. I have contracts for everything, because contracts and agreements are everything in the world.
Yep. A lawyer once told me agreements are really disagreements. Like that's what they're there for. They are there as a, they're there in case there is a disagreement, right? You don't pull out an agreement when everything is good.
100%.
There's a disagreement, and that is the time you're going to kick in yourself that you didn't get an agreement. So even if I'm the same way, I loan money, I loaned money to my little brother for something the other day, and he just signed a PDF, and I just explained how much I loaned him. I didn't charge him interest or anything, just
100%.
we discussed. And it wasn't so I can go back to him. If he never pays me, life goes on. But if he's like, oh, I thought I agreed to this, well, here's what we actually agreed to, because we wrote about it. And it helps with relationships, especially if you are getting family and friends involved. Like,
yep.
It's good for your relationship to do that.
Yep, 100%. It's just, yes. How much you're going to pay them? Like, what is the payback situation? What is being done for the compensation? And is there consent from all parties? That's all you need. It doesn't have to be long, elaborate. I did one operating agreement, it's 107 pages. They don't have to be like that, right? They can literally be one pagers. They can be on a Post-it note, right? If everyone signs and it's legible, then you're fine. So, and then to answer Craig's, I believe, question, entertainment 0%. It has not come back at this point. So although the meals went from 50 to 100%, entertainment did not work. Even golf, unfortunately, because that's where a lot is. But again, it was just the easiest way to say it, that rule was kind of abused. Not kind of, it was abused. So that's kind of one of the things that went away. And that's, again, if you guys want to get the case law, we absolutely can, but it was abused.
What about entertainment in regards to those trips we were talking about? And I think it's still a no, but so I'm taking a trip hypothetically to Vegas, and in Vegas, I can write off the trip because I can prove that the purpose of this trip is this Realty One Group conference, and then I can write off meals while I'm there.
100%.
I'm on a trip for my business, but anything beyond meals and actual trip expenses, i.e. Uber and so on,
yep.
and where you're going to say anything else that you decide to do is not deductible, right?
100%. It's the events. And so literally, like when you go out, like I'm the most. So I bring multiple cards with me. So like I always walk around with my business card, my debit card, my business credit card, and like 7 other credit cards, right? And so I literally have a card marked for like hotel stay and everything like that, and then everything is like out. So when you go to pay for an entertainment piece, then that's it. And so where you want to be like careful on like how businesses are structuring is business will charge like $80,000 for a ticket. And then as a part of the education thing, so you see this a lot with Tony Robbins, right? he teaches the whole thing, so that whole thing's deductible, but you generally have a concert in there. So that's the only way that it could be wrapped in, is if the person you're buying the event for wraps education into it. So like if that happens, like, so again, the Grant Cardone 10X conference, Pitbull's also going to perform. So you don't have to split out like a portion for the entertainment portion that you got, because you're just paying to go to Grant Cardone's 10X thing. So that's kind of thing, because people are really starting to mix it together. So if you're paying for education, paying for an event, then that's a tax deductible event.
Yep, that's a perfect example, because at the Realty One Group conference last February, they had two people who won America's Got Talent, a ventriloquist and a magician, and obviously I didn't have to do the math. What portion of it was for that? Like that was all part of the conference, and the conference is a write-off. So that's great point. What about gifts? I don't think I'm skipping anyone's question. I hope I'm not. What about gifts? I've heard mixed things on that. Like you can only deduct $25 of gift. Is that the case?
Yeah. So your gifts are capped at $25. I don't want to get anyone confused. So $25 that may be going away. I get like just in the tax ether. That's what they're talking about. But right now your gifts are capped at $25. And so kind of calculate that in, right? Because when you said a TV earlier, I thought you actually bought someone's TV, and I was just like, oh no. Okay. So yeah, just trinkets, and that's where like, yeah. So yeah, $25.
Okay. Gosh, I might get us in trouble. Hypothetically.
Yeah, hypothetically.
Here. I know a lot of real estate agents. None at our office. No, just kidding. They will give their buyer a home warranty, and it will be paid for out of closing. So I have a $10,000 commission. I'm giving Christy, my buyer, a $500 home warranty. So all I make is $9,500 because it came from my commission. So because it came directly out of my commission. Now I'm saying it sounds crazy, but for some reason I thought in my head that was okay.
So that wouldn't be categorized as an expense, right? So the easiest way to say this is that you guys don't sell houses, you guys just sell widgets, right? It's just inventory. So now you are increasing the cost of goods sold, right? So you're increasing the value of the good by putting money into it. So you just increase the profit. So that's a part of the cost of goods sold. So that's not going to come out as a gift, right? So we're getting in kind of into the accounting world now, like how you would code it, but like that would not be coded under gifts. That's a job. It would be I have QuickBooks on the brain. It would be another expense on the form. I think it's like box 21. And I would write realtor expense, warranties paid out, right? Warranties bought. So like, that's not a gift, that's an expense, right? And the gifts, like where it kind of happens again, like, like abstract to and thank for, right? So it has no relation to real estate. So I know it's cloudy still, but like I can tell you that specific example is not a gift.
Yeah, so that's a big reason why I know a lot of real estate agents do that, guys, is because it's a 100% write-off. If 100% write-off gift that your client will really appreciate. So that is why a lot of people do that. You can another gift that you can write off 100%, and I really should be careful what I say. What I've heard, you can take someone to a really nice dinner right after as part of the real estate deal, and be like, I mean, I do this for a lot of clients. I'll take them to a really nice dinner, and they know that the bill's probably $300, and that's fully write off, because that's what we were talking about real estate. We were talking about the sale, and that's one way. That's another way you can do it. But the gift one kind of sucks, because to me it totally is a business expense. When I buy someone a $100 bottle of wine at closing, but it sucks I can't write off that whole $100. I mean,
100%. And like again, so I won't bore you guys with tax law. It's a lot of the caps and a lot of the things that went away. It's because they're abused, right? And I don't want to point any fingers, right? Because like that makes it. I don't want to make anyone an enemy. But if you look towards New York, near Manhattan, there's a group of people there that were abusing a lot of these rules, and a lot of case law came out from that. So it was just a change that I don't want to say we're suffering, but that's where it came from. So unfortunately, but the meal, he makes a great point. Taking them out for a meal, like, you're not giving them anything. You're building rapport with the client, trying to do future business. Again, this is all it, right? You're just doing more business at the meal. So that one's going to be fine.
Robin had a really good point that I I'll let you confirm, Larry, but she was saying another loophole she believes, and I think she's right, is you can write off 100% of a gift if it is marketing. And so something that people do is they will buy a cutting board, for example, that has Isaac Schaefer, Realty One Group turnkey on it. And then you can call that marketing because it is a marketing piece. And then you can write off 100% of it. What are your thoughts on that?
Yeah, no. So again, like this is where we go aggressive, and pigs get fed, hogs get slaughtered, right? So the cutting board's $8,000. They're gonna come. They'll come. If it's, you're right, if it's like $100 marketing piece, like that's 100% it. And again, the big piece in there, that's the takeaway, is the branding on the item, right? So when you start branding things, because then what's the difference between that gift and postage, right? People send out little calendars all the time. Is that a gift or marketing? So that branding, whether it's your personal name, the business's name, is really what separates that marketing campaign. Like it has to have a distinct link to marketing and advertising. And that specific example does.
And for the record, Larry keeps saying a lot of things like a gift can only $25 can be a write-off. That's fact. Larry's what Larry's saying, like, hey, do you want to risk it? That's where it really is up to you. And Larry would say that if you hire Larry, he would be like, this is what my CPA does every year. I go to him, I have my profit and loss. Essentially, I say here, and then I'll have some questions, right? I'll be like, hey, what do you think about this? And he'll say, I think you're pushing it. But it's up to you. That's what correct me if I'm wrong, Larry, but that's what most accountants and CPAs are going to say. They're going to say, here's my opinion, but it's up to you. So just know that this is, when you start to get along the gray area, that's going to be your decision. How much risk do you want to take? And you get to decide on that for yourself.
No, 100%. And that's why, again, like there's preparation and there's planning. Preparation, I mean, we do, right? I do, everyone will do. Where you're going to make a lot of your money is the planning. And that's a great planning question where like you can ask the specific question, like, hey, I'm doing this on this day, or I did this way, or I went out on this meal. And that's where, like, again, it doesn't have to be me. I highly recommend though, even if it's once a year, quarterly, bi-yearly, is it semi-annually, twice a year, I would meet, again, some people charge, some people don't, but I would pick their brain because the tax law changes, right? Just like the easiest glaring example is meals are now 100% deductible, right? So I guarantee a lot of people are going to have better meals now because they're just like, okay, it's a business expense. So planning, everything specific, and every situation is different. But yeah, that's a great answer. It's that specific example, especially if it's your name big on it. Like I wouldn't tell you to do it, but like I'm always hesitant just to blanket go ahead and do it. Every example is different. Realtors are a different beast because you guys are just high octane people. So you guys market everything, right? Because again, that's how you get your name known.
Love it. I got one more statement, and then Larry, if you want to speak to it, if you have anything to add. Think about as a real estate agent or an investor, when you are doing your taxes, again, obviously be honest. Write off expenses. Don't write off things that aren't actual expenses. With that said, something to just know when you're doing that is when you are going to buy a property, you are going to your financeability, that's probably not a word, is contingent on how much money you claim you make. So if you made $100,000 last year and you say you have $60,000 in expenses, and again, I'm not getting into whether or not those are legit expenses or not, but you have $60,000 in expenses, you made $100,000 gross. That means you made $40,000 last year as far as the IRS is concerned, and as far as a lender is concerned. So it's just something, I'm not even really saying I'm not going to say thus do this. I'm just saying, just keep that in mind, because if you made $40,000 last year, you're probably not going to qualify for anything that you can buy in Pierce County or King County, right? Just something to think about too. There's a cost to deducting every little tiny single expense. The more money you make on paper, the more you can buy, the better your buying power is.
100%. And you said it beautifully at the end. And that's why, again, I'm always, as the tax person, helping you look ahead, right? Because a lot of people, we all hate taxes. It's the biggest expense on our profit and loss statement, and we don't talk about it enough. But when we come together, I ask, like, hey, what are you doing in 1 year, 2 years, and 5 years, right? Because that 1 to 2 years is where you have to establish that amount of payment. So I'll give a different example. I have a client that hauls trash, right? And he bought a new truck. And so since he had the truck, it's over that 6,000 pound limit. He had the opportunity to take the 179 expensing, right? So we could have expensed that whole $75,000 truck in that year. And it would have made him look like he's making like what, $10,000, $15,000. But then we're talking through it. He's like, well, we want to buy another house in a couple months from now. I'm just like, whoa, hey, then we shouldn't take that expensing. You shouldn't take that deduction on this year. So we built a strategy around, depreciating it out over the 5-year schedule and then making it look like he made more income on paper because it mattered more, not today, but in 3 months when he went to go buy a house. So I would wholeheartedly, again, this is why planning is so important, because you can kind of come up with those human things. Because when you look at your when you look at your W-4, I think it's like box 13 or 14, it's going to say adjusted gross income. And whenever you go get qualified by a mortgage or a lender of some sort, they're going to say, okay, well, they make this much in adjusted gross income. They qualify for this much real estate, right? And that's super important. And generally you don't see it with cars because cars are kind of easy to get, but with property, as you try to expand that real estate kind of kingdom you're building, that adjusted gross income matters. So like taking every single deduction and being super aggressive and only paying $12 in taxes is super fun, but it's not going to always build out for the future.
And just to kind of put a cherry on top of that, this is why, in my opinion, it's just a no-brainer, guys, to hire Larry or someone like Larry. Like, seriously, do not trip over a penny. This is like doing your own electrical work. It's the risk is not that the plug doesn't work. The risk is that the home burns down, right? Yeah. One thing, if you're going to try and build, do the tile in your bathroom, which will, good luck with that too. But at least worst case, the tile falls off and you have someone come correct it. If you do something wrong with the electrical, the house could burn down. And that, we're talking really important stuff here. It's not like if you are wrong about how you do something, the IRS is going to say, oh, no problem, man, you can pay us now. They're going to say, oh, no problem, you can pay us now plus interest, and here's some penalties too.
Yes.
Next year. And also see you next year, because now you're more likely for the rest of your life to be audited because you've been audited once. So just something to think about. I don't make anything if you hire Larry or any other person. I just really believe this is not something to mess around with. And it's also, I think you'll be surprised. I have no idea what Larry charges, but I think I've talked to people who are like, man, I don't want to spend $2,500 on filing my taxes. I'm like, who are you talking to? It shouldn't be. And again, I hope I'm not putting Larry on the spot, but I doubt it's that much. So just really think about hiring someone like Larry or Larry. And on that note, Larry, since I don't have any other questions, do you mind plugging yourself, telling people how they can learn more about you, and if they're hiring you, how they can go about doing that?
100%. So like on we're revamping my name email, but like the email they have out, Robin pushed it out. You guys can email me, right? Like, again, we'll sit down, we'll talk. I'm not going to gouge you. I don't generally charge in on the first interactions. This is what I'll say, right? Because obviously you guys know how to reach me just about real or tax professionals in general, right? Some are good, some are bad, just like real estate agents, right? We're kind of the same, except you guys are way better at talking to people. We're terrible at it. Our job is to save you money and to teach you, right? So when you're talking to them and you don't feel like they're teaching you, or you feel it transactional, just leave that person. It doesn't have to be me. I really don't care if you come to me. But when your guys are doing this, I understand when money's tight, it's easy to look at your profit and loss statement today, but you always want to be building everything out like 5-10 years in the future, right? Because again, when you think of yourself as a $10 million brand, whatever that fee is between a reasonable, like $500, $600, $800, you'll never think about it, right? And so you want to build something with someone that's going to help you get to $10 million, right? Because again, I can't say it enough, because you'll get tripped up. It's just not worth it. And the last thing I'll say is, as you guys grow, time is your best effort, right? You're going to be a high return real estate agent. The 10 hours it's going to take you to do an S-Corp return, I promise you, when you get to an S-Corp level, like it takes us it could take us up between 4 to 6 hours just to do them, because they're kind of complicated. There's a lot of nuggets. So if you're taking 20, 30 hours to learn that, like you're not selling, you're no longer making money. So again, get with someone who's going to teach you, get someone who's going to save you money, and get someone who wants to grow with you. Other than that, like I said, all of my information you guys have. This was awesome. If you guys have any questions, email me. Text me. Please text me. Don't email me right now. I will do my best to get back to you as fast as possible. And I've been doing a pretty good job so far. So thanks for having me, guys. Isaac, thanks for having me out. This was awesome, and we should do it again.
For sure. I just want to repeat something you said, because I love that analogy that you, it's, if you start building a 3-story home and then you decide after 3 stories that you want to build a skyscraper, if you're thinking about this like a business, guess what? You're going to have to start back at the bottom, start back at the foundation. You can't just say, oh, let's throw another 7 stories on top of this. It doesn't work. And so I love that, right now, especially for you newer agents who are maybe doing 4 to 8 deals a year, and you're like, man, I really that's another business expense. It's tough. Just think, are you happy with 4 to 8 deals a year? Or are you going to be one of those agents who's going to start doing 12, 18, 24, et cetera? And if that's your goal, if that is your goal, then start building the foundation for that now, so you don't have to start rethinking things in a year or two as you start getting that success. And so I love that analogy. Thanks for saying that. And yeah, thanks everybody for joining. We'll do a little more intermediate meeting in a week or two and just kind of talk about, again, the furthest thing from a tax expert, but I love all these different, I have got a lot of different hacks and apps that you can use that will help make tracking easier. So we'll do that soon. So stay tuned for that. Thanks again, Larry.
No problem, guys. Thanks for having me. No problem.
Thank you so much. We appreciate it.
No problem.
All right. Take care.